everyone, and welcome to Analysing Trending Markets.
Yes, analysing trending markets. So last week we had the surprise announcement from the RBA where we saw interest rates cut, surprisingly, and obviously we've seen a big move on the Australian dollar towards the bearish side, so it's been moving down steadily. And what we thought we'd do is we covered a little bit of fundamentals last week, but now we want to cover how to analyse change of trends using technicals. So it's a little bit of, we'll look at the technical side, we'll look at the fundamental side, and we'll bring them together. Now, as always, I'd like to start with the risk disclaimer. So anything we're talking about today is always of a general nature. So this presentation/documentation is purely for educational purposes. The information in this presentation/documentation is of a general nature only. It does not take into account your specific needs or circumstances into consideration, and you should look at your own personal situation and requirements before making any financial decisions and seek independent financial advice if necessary. So now that we have that over and done with, what we're going to be looking at today is technical theory, economic outlook, real examples, and some live examples. So with the technical theory, we're going to be talking about how to read trend using price action, so actually reading it from the candles or the bars. Then we're going to be taking a look at the economic outlook, so we're going to look at the changes that all of the big investment funds have made, so things like JP Morgan, Morgan Stanley, all of their experts have now changed their expectations for the Q2 and Q4 results. And then we're going to look at some real examples of how to recognize change of trend in the market itself, reading price action, and some live trades. We've actually got a live trade on this week, so we'd like to talk about why we got into that and all of the things and our thought processes about how we got into that trade. So we'll start off with a definition of trend using highs and lows in the first time frame, or what we call the first time frame. So everyone's seen bars or candles probably by now, and you'll know that a bar or candle has a high point and it has a low point. Now, when you see a series of highs and lows, and you see next candle and the next candle on making higher highs and higher lows, it's what we call an uptrend. So if we had one bar with a high and a low, and then the next bar opened up and made a higher high and a higher low, and then it kept doing that, it's what we would call a first time frame uptrend. That would go the same for a downtrend. So if we had a bar open with a high and a low, and then the next bar or candle opened up and ended up creating a new lower low and lower high, it would be what we call a first time frame downtrend. So to put it a bit more plainly, this is what we'd be looking for in the market. A series of bullish candles continuously making new highs, so really strong trend, or a series of bearish candles continuously making new lows. So Tyrone, would you like to talk about that a little bit more?
Yeah, just the market imperfections never really exaggerate what a trend really looks like. So when we see it in this context, we can see that each candle is very different to the other, but we can see that there's a very clear new high and a new higher low on the green side, and we can see that although the candles are all different shapes and sizes, and all candles do mean they've all got their own representations of what's happening in price, but they are giving us the overall trend, and we are seeing an uptrend there. Again, on the red side, we can see the downtrend is in full motion. We've got lower lows and lower highs being formed all the way down. Even though we've got totally different candles, we can definitively say that we are in a downtrend in this time frame.
Yeah, so what a lot of people do is they use things like moving averages to find out how to read trend. They'll also use different indicators or even just visually look at stuff, and that's fine. But sometimes it's good as technical traders to have hard, fast rules to actually, analyze what we're looking at in the market. So here we've got the first time frame, and all it really means is a series of higher highs and higher lows in the uptrend, or lower lows and lower highs in the downtrend, and that's just in succession. So we can see here, if a trend was about to change, we'd have that higher low, or higher high and higher low, and then next candle actually ended up being bearish, so it had a lower low and lower high. So that's when you talk about first time frame changing trends. Then we've got the definition of trend using peaks and troughs. So what this is basically just saying is that when we've got a first time frame continuation, so higher highs and higher lows, we end up seeing a movement, and that movement's this bit here. Then when that higher high and higher low breaks and it turns down and it starts creating lower highs and lower lows, or goes into a first time frame downtrend, that then forms the peak when that starts, and then we go down and up. And this is basically what people call swings. So when you're looking at a market and you draw Fibonacci's and you see the market might go up 100 pips, come back 50 pips, go up 100 pips, come back 50 pips, and so on and so forth. Really what you're looking at is a second time frame peaks and troughs, and we call them peaks and troughs. So we call every time it makes a new high, we call that a peak, and every time it makes that pullback, we call that a trough in an uptrend. And of course, you can see here it's similar in a downtrend.
That's right. So when we've got a series of troughs and peaks all going in the direction that we were talking about in the slides earlier, we can see that even the middle time frame, or the second time frame, if you like, is actually also in an uptrend and a clear downtrend, respective of which way you're seeing it. So what we're looking for in these situations is a series of bars that are forming these troughs and peaks, pulling back and then reversing, having a small trend reversal, so we can definitively say again that the middle time frame on whatever chart we're looking at is in an up or a downtrend. Okay, so this is basically using price to determine which way the trend is going, and of course price leads all action, and it leads all indicators. So as much as a lot of people do use moving averages to basically decide where the trend is up or down, like if we use a long-term moving average like a 50 or a 100 moving average, if price is above it and it's tracking up, we can usually say that yes, we are in an uptrend, or if price is tracking underneath it and the moving average is falling, then we can say that we are in a downtrend. The good thing about what we're looking at here is that we're using price to actually decide which trend is up or down, and it gives us clues as to when the trend is changing a lot earlier than a moving average would. So a moving average, as most people would know, is based on the last 100 candles if we're using a 100 moving average. So price can take quite a while to actually turn up and get above it. So that does give you a lot of opportunities that could be potentially missed if you're not using price action to determine the trend.
So here we have just a couple of line charts, and this is maybe if you just moved a strong trend and turned it into a line chart in your MetaTrader 4 or CTrader platforms, you'd probably see something similar like this in a uptrend and something similar to this in a downtrend. So if we count them out, we have price coming in, it forms a low and then changes trend and goes up on the first time frame. It then makes a peak, then it comes down, then it goes higher again, and then we can call that a higher trough, and then it makes new higher peak, new high trough, and so on and so forth. So what we're looking for is those movements in the market, and at a certain point we can actually justify a change in trend, and we're going to talk about that with the Australian dollar. And it would be the same here for the line chart on a downtrend. You can see how the peaks and troughs are formulated based on a line chart anyway. Now what I'd like to do is just jump straight into the charts quickly and talk about this from the Australian dollar standpoint. So let's bring up the Australian dollar, US dollar, and let's go to I guess probably a daily chart would be best. Oh, I've got a bit of lines here. We'll just get rid of some of this. Okay, so here we've got an uptrend. So we've got, if we change it to a line chart, you can see price has gone up, made a peak, come down, made a higher trough, come up, made a peak, higher trough, new higher peak, higher trough still, and it keeps doing that all the way up. Now at some point we're going to actually be able to say, well, it's not making, it stopped making higher peaks and it's now making lower peaks and lower troughs. So Tyrone, would you like to go through that quickly?
Sure. So what we can see, we did go over this chart last week, and as you can see, the price obviously did what we thought it was going to do once we did get that divergence. But we can see that this peak here was the highest peak of the series, and we can draw a line there and see that it did hit previous resistance, which has basically formed a downward trend. Now we've got a trough here, we've got a lower peak that we could put that there. I will move it to a candle and a bar chart shortly, but I just want to show you what it looks like on a line chart. And for those of you who are thinking, where are these peaks and these troughs? If you're inexperienced at actually looking for them, it may be a little bit daunting at the start, but if you apply the candle rules that we were talking about earlier of definitively saying where a peak and trough is, it does make a lot more sense. And if it's easier for you to actually draw a T and a P on the chart, then definitely do that, because it just makes it easier for you to reference it. there is an indicator that will give you a little bit of a clue that we might put on for you later if we have time, that will actually show you peaks and troughs. But for now, we can see that we've got a lower peak, we're making lower troughs, prices again trying to rally up, but we've got a lower peak again, we've got another lower trough. At this point here, we can clearly see that we're in, the trend has changed, we're clearly in a downtrend, especially when this peak gets broken, when this peak goes down from here, the trough gets broken, off we go. There's no question we're in a downtrend. We're hitting a place now where what was once resistance could become support. So it's definitely a place to look out for. But this is, again, all the analysis that we've done over the last few weeks coming together. So, but as far as price is concerned, we're definitely in a downtrend with the peaks and the troughs getting lower every time it makes it.
So let's just talk about it from a first time frame standpoint. Here we have a bearish candle, bearish candle, bearish candle. Then it's got a bullish candle, but in this case, the bullish candle hasn't made a new high, and then the next candle opens up and makes a new high. So this is actually now the first time frame downtrend, and we've started the first time frame uptrend. You can see it's made that new high, then broken down again. So this is where we can actually read it as peaks, troughs, lower peaks, and then now it's formed the lower trough. So it's about really seeing the previous candle, and maybe what we'll do is we'll provide some documentation or a way of getting documentation over the next couple of weeks to see this in a bit more theory, because it is quite a hard concept to I guess, figure out.
It can be a bit hard, and Joshua was asking, how many candles in a row would constitute a change in trend. Well, Joshua, it doesn't really matter how many candles there are, even two candles. So the example that Thomas was showing you there with the two candles, the two bullish candles here, that is enough to actually basically say, yes, we have got a change of trend. All it requires is two candles in succession that's got a higher high and a higher low, and that will constitute putting a P at the top of that and an L, a T underneath it. We don't want to go. We're not a lower T at that point. But yes, the candles don't really matter as long as they're making higher highs and higher lows. There's no limit to the candles, but of course you do need at least one. But yeah, one higher high and higher low does start a new trend.
And to a lot of people, I mean, maybe to simplify it a little bit, a lot of people look at candle charts. If we're seeing this, we've basically seen higher highs and higher lows the whole way through. It hasn't made a new lower low. So you can see price keeps going up. It tries, it kind of fails here, and then it comes back up, and then it completely breaks here. So if we're just talking about a support resistance standpoint, as soon as this candle comes through and breaks here, we really should only be looking for shorts. Now, if we're looking at that and we're always looking at support resistance and recognizing how, I guess, the market flows, the moving averages may not actually be saying, let's start looking for shorts or looking for sells in the market. But it turns out that by using price action and by recognizing a break of a critical level or the previous troughs, we can then say we're now in at least a daily short-term market. So short-term bearish market.
And to give you an example of what we're talking about, I think we might even put a 100-day moving average on the chart, and actually let's just put that one on there.
So insert it.
We'll just have
So we'll just grab that for you. Oh, whoops. Too used to dragging and dropping there. Okay, and 100 days, and exponential is simple.
Exponential will be fine.
Use exponential. Okay. So here we've got a 100-day, and we can see that the conventional rule would be that when price breaks under and closes, we would be therefore looking at the downtrend if we were using a 100 moving average.
That's right, and 100 is a very popular moving average to determine trends. So a lot of people.
The Dow originally.
Absolutely, they use the 100 and the 200 as very important indicators to determine trends. So 100 is probably the smaller side. But what I am going to do is I'm going to draw a couple of lines on this for the people, because I've had another question just in regard to peaks and troughs and not quite making sense. I'm going to draw some lines to join some of these peaks and troughs, just to give you a little bit of an idea of what we're actually talking about. Okay, so I'll just keep talking while we do it. And basically, if we look at where the peaks and troughs are forming, and we basically join them with lines to isolate the peaks and the troughs, we can see clearly that a pattern's starting to form here. And I encourage people, especially the ones that are learning this for the first time, to actually to draw these lines, because it does give you a very good view. And what we are going to see in a second, it's a little bit of a slow process, but what we are going to see in a second is a very clear break of a trough that's giving us a very early indication that this particular currency pair, being the Aussie, has changed direction. Okay, so what we can see there, I'll finish off we're starting our downtrend very, very shortly. Okay, this one's a little bit more difficult to see. I'll just put it there because it's a red line, so we can see what it's actually doing. But I'm sure by now you're probably already seeing that the patterns are starting to form where we're making the lower peaks and the lower troughs. We can probably take this one all the way down.
Yep.
So, okay, so what we can see now is I'm going to change this to a bar chart to make it just a little bit easier to see. Okay, so what we can see, we've got very clear troughs and peaks now, okay, and we're just using price action to determine that. So we've got a trough down here, we've got a higher peak, we've got a higher trough, we've got another higher peak, another higher trough, another higher peak, another higher trough, another higher peak. Very clear uptrend, okay, so there's no disputing that. What we've got here, when we started to see the weakness in the market, and remember we did talk about the divergence in the MACD or 2 weeks ago now, that this was starting to peak out. So we did have an indication, even at these, as early as these peaks here, that the MACD was starting to drop. So we did start losing momentum in the market. Okay, but our first clue of trouble for this currency pair was right about here when this peak didn't get above and make a new higher peak. Okay, so as soon as we had this peak after a trough form, we were always going to start looking for clues as to when this trend was going to give us a sign of reversal. Now, anybody following the candle rules would know that once this lower trough got broken, it stood to reason that we had to get a lower trough after this point. Okay, so once I'll put a line there just so we can see it. Okay, so once this trough here was broken by this candle here, we were in a confirmed new trend down. Okay, so if we wanted to, any confirmation that we were looking for happened right on that candle. Once we got that new low, it took out these the support that would have been formed here. We were in a new downtrend in this area here. Now, if we were waiting for the moving average to signal what was going to happen, like traditionally people do, look how many pips we would have missed out on. We could have easily taken a short at this point here, which is around, let's call it the 76.70 mark. And prices got as low as 380 pips from there. So we would have had to have waited for a confirmation close to break a moving average. So if we were waiting for a moving average to confirm the change of trend, we were waiting for this bar here, which is nearly 380 pips later than what the price action would have given us. Yep. Now that's nearly 4 cents. So that just goes to show you how important price action and understanding how the trend changes in price action work give you an advantage over the slower moving average approach.
Yeah, and I think another thing is what we sometimes like to do is, as Tyrone was saying, the first break you can take it. It's fairly aggressive because sometimes it is maybe a fake out. We all know that sometimes happens, but by a price action standpoint, it always holds true. But if we take it when it makes let's say a peak, a trough, a lower peak, a lower trough, a lower peak, and then it breaks that second lower trough, you can absolutely say that this is now in a downtrend from a price action standpoint. And at that point, you can absolutely sell or buy the market, depending on, of course, what trend you're looking at here. But in this case, we could have sold. So if you wanted further confirmation, when it breaks past this second trough, that could have been your initial entry as a more conservative, I guess, trader. And this, amazingly enough, if you do it this way, you'll actually stop ever really getting into counter trends. You'll also stop ever really getting into fake outs as much as you may do with a moving average. Some people use 2155s or 2050s. I have Dave, he's saying, I use a 2155. Yeah, a lot of people use that one.
It's very common,
cross,
yes.
And 2155 crosses, and then you start looking for shorts. And that's fine, but look at the difference that you can get into. And more importantly, a lot of people are saying, well, I used the 2155 and that got me into the Aussie faster. It may have, yes. But if you look at a sideways market, maybe go look at the Euro US dollar at the moment, where it's moving up and down a couple hundred pips, but over the monthly or weekly charts, it's really not doing that much in any direction. Moving averages can get you stuck in zones you don't want to be in.
Yeah, and quite often when they do get stuck, they find themselves twirling and coiling quite. They can give you so many fake signals, and yes, when they do eventually break, it is usually a very big move. But again, moving averages are created by price action. So if you learn to read the price action first, you're going to be ahead of the game on the people who are actually only using the moving average.
And I guess the other question is, would you rather be in early and correct, or would you rather be in early sometimes or even earlier, but a little bit less correct? So when you read price action, you usually don't get stuck in trades or bad trades as much. So it's really worthwhile, especially what Tyrone just did here. It's a really excellent way of visualizing peaks and troughs that makes it very easy to understand and to do it without, as much knowledge, I guess.
Absolutely. Stacey's just asked, how do we know when the trend has stopped to the downside? Well, Stacey, it's the exact opposite of what we've seen here. Okay, so basically what we're looking for now is a higher trough to form, and that will make a newer peak. So if we were looking at the pattern here, we're basically drawing this up. If we see price action start to do this, all of a sudden we've got a reversal of trend again. So now we're starting to look for longs, because we've basically got prices telling us that it's reached an area that, one, it's going to have trouble breaking, or it's just a consolidation area that could force it up to test potential support that was resistance earlier on. So we would fully expect that if it did find a bit of a base in this area, the first place it's going to find trouble is our line that we've got here, okay, which is previous support for that channel that we've been talking about for several weeks now. So yes, it's the opposite of what we were talking about up here, just that it starts to make higher peaks and higher troughs. And the first time we've got a higher peak, higher trough, and a new higher peak, we can start to long it till the cows come home, because we know that we've had a price change.
I've actually got maybe an example of this. So let's just take a quick look at a 4-hour US dollar CAD. So we've got here the US dollar Canadian dollar, and we can see that price is it's been pretty much consistently coming down. So let's just draw this up quickly. We'll pretty much have to draw everything here, I guess.
It just seems so much clearer when you do draw these lines. It was a tip that I picked up very, very early on, and I did it probably for the first 3 years of trading. And as much as it was actually a difficult, it was a difficult habit to break, actually, because as much as you can see peaks and troughs once you've done enough of them, it just gives you such a good visual representation of it. There's just no question, and you can look at it from a distance, and in a glance you can see where it's tracking. And of course, when it does agree with the moving averages, it's well and truly established. So the trend is well and truly established by then.
So this one, actually, the moving average would have potentially been quicker than the at least 4-hour price action, because you can see here how aggressive this move was. It was actually due to fundamental reasons, but when it creates this new peak, new trough, and then breaks that peak, you can be looking from a price action standpoint of getting in. And it is important. Sometimes you'll see these closes above, up here. Sometimes they'll look like they should be, they're potential longs, because you should be buying into these because they're closing above that moving average. But actually, if you drew all of that up, you'd find that it probably won't be a second time frame break. Exactly. And therefore, that's why price action can save you from getting past moving average closes.
As much as it's closing above the moving average, it's still making lower peaks and lower troughs. And while it's doing that, there's just no
And
change.
Really all this is about is just encouraging you to go check it out, maybe have an open mind, see it for yourself. Have a look at the euro. Start drawing it up on the euro US dollar. That's a good one to see how it competes with maybe a moving average or whatever you use for trend. Now, let's get back to the slides quickly and talk about a few other things. So, economic news of the week. Let's talk about the normal news we look for. As always, we haven't changed this list at all, but for anyone new, always look for Reserve Bank Chairman talking. It's a very important piece of news. If you see the RBA, Governor Stevens coming out and saying something, always be careful of around that time, because that can influence the market a lot. We've got monetary policy decisions, very important, again, usually from the bank chairmans. Interest rate decisions, again, from the bank chairmans. And non-farm payrolls, which is always the first Friday of each month. So I always encourage anyone that's never seen non-farm payrolls, go check out non-farm payrolls, first Friday of each month. Maybe don't trade it, or maybe trade it in a demo, but have a look at it. And if you're not comfortable with it just yet, see how it reacts to the market, because you'll see some very interesting news come out and you'll see some big moves in the market at that point. It's one of the biggest pieces of data of the month. And then we've got bank holidays. So the reason why we wrote bank holidays is if you're expecting big moves on bank holidays, especially US bank holidays or UK bank holidays or anything, usually it'll be a slowdown in the trading. Bank holidays means no traders, yeah?
You're in for a sad day.
Yeah. Don't be looking to scalp 50 pips on a bank holiday, generally.
Yeah, I think that's probably the most important thing to take out of some of that news is that whatever's going to be released, you just have to move your stop loss and take profits accordingly, because you're just not going to get very big moves the day of non-farm payroll when the whole world's waiting for the unemployment changes. It's just not going to happen. Yeah, quite often. I mean, I as a rule don't even trade non-farm payroll Friday. I actually trade Fridays in general, but non-farm payroll Friday especially, because it's just a very, very flat day. But it is a lot of fun to watch, and I certainly encourage anybody who hasn't seen it to basically check in and have a look what happens the minute non-farm payrolls gets released, and even the minute before. It's a very exciting time in the market.
Yeah, very exciting time. Now, here we have the Australian US dollar 12-month predictions. Last week we brought them up. Some of the guys like JP Morgan, Morgan Stanley, Wells Fargo hadn't updated their results yet. So if you compare it to last week, you'll notice JP Morgan and Morgan Stanley specifically dropped their expectations by another cent to 2 cents. So now it's sitting at 71. And most of the really big, well-known guys are all sitting under 73. Now, I know it looks like the median price says 73, but most of the big guys are sitting underneath 73. And if we look at this chart, you can see this is last week's and this is now this week's. So a little bit less, I guess, high outliers. Whoever he may have been getting a little bit too confident in the Australian going up, but he's gone and he's now brought it all the way back down under 80, and everyone's sitting under 80 cents now, and there's a few more people looking at the very bearish side. But overall, just really reaffirming that 72, 73.
There's nothing like a 4-cent move to get people moving on there.
Wow, nothing like a surprise interest rate decision. But definitely affected the quarter 2, and it's also affected the quarter 4. So this is the quarter 4 from last week, and this is the quarter 4 from this week. So actually a few people bringing it up as the expectation here, but you can see a lot more centered around those low 70s.
Yeah, and we're always very mindful, like we've discussed in previous sessions, that the Reserve Bank gets what the Reserve Bank wants eventually, and they're very comfortable with a very low 70s Australian dollar, and eventually they will get it there by all means, and they've got the best arsenal available to them to actually make that happen. So it's always very, very important to understand what they want and where they're tracking to for the longer term view.
So let's just take a quick look at the Australian dollar. I just want to bring up, if you haven't already figured it out, we're fairly bearish on it overall. It has hit the level where you now need to be careful. So we're talking about that support resistance levels. You can see here the market had previous resistance at around this 73 zone. So we'd expect that to potentially be more resistance for the future. So, more support now. So the market hit this point, about 73, and you can see resistance, finally breaks through, and it's now the first test. So be careful around this zone if you're looking at more shorts, and always make sure you've got technical reasons for the break, or maybe even wait for a break.
Definitely. Now, Harry's just asked about the moving average, and now that it's starting to turn around, would we be even more inclined to go short? Well, Harry, yes and no. There's two parts to that answer, because realistically, yes, we're for the astute shorters who use price action to get in, they're already probably taking profit. If they haven't already taken profits, quite a bit of profit taking has happened here, and essentially that's what's caused price to consolidate in this zone. It's obviously got previous resistance and support working with it. Now, price is probably going to go up and test this 100-day moving average. So I would imagine that I wouldn't think it was going to drop like a rock from here, just purely because of the interaction with the support and resistance levels. But at the same time, now that the 100 moving average is starting to turn around, if price does go up there and test it again at around the high 73s, I would probably be looking for a shorter time frame indication that price is going to turn around again and get ready for its next short, because I'm not convinced that this level will actually hold the 73 probably will break if it gets an aggressive move or reaction off that 100-day moving average.
And we also need to think about surprise announcements. So if anyone hasn't been trading that long, or if anyone does remember, the surprise announcements on the US dollar yen. So if you look at the massive bullish run the US dollar yen had over the last couple of years, that was because the market didn't expect them to continuously lower interest rates and print money. And because they were doing both at the same time, unexpectedly, forecasters didn't know they were going to do it at this rate. You could see it continuously went up. And what ends up happening is when these surprise announcements come out, it's not packed into price. So you've got that initial shock news, and you can see that initial shock movement. But what you can be sure of, generally anyway, is that when you have a surprise announcement, price has not been packed in yet, and we usually don't have all of it hasn't been allocated into what the Australian dollar should be worth at fair value. So you can see the initial shock reaction moves all the way down, breaks past those support levels, and then now it's gone another 190 pips. So there's usually a little bit of leeway. So if you always miss out, or you sometimes feel like you miss out, remember, if it's a surprise announcement, you're seeing the technicals to back it up in terms of the breaks of the new lows or the breaks of support. No reason you can't really get in, because there's usually a little bit more. And in this case, we also had that really strong resistance level, which meant that price was probably going to come down, at least test this area.
Definitely. Well, we would have fully expected that this would be the zone where price would at least halt. It would take a very serious shock to actually break this level without any form of resistance. So, yeah, it definitely did what we would, or most would expect to happen. But now, yeah, the next little period is going to be very interesting.
Now, Dave's asked again. He's asked the question, I can see the gold trade that you've got down there. What's happening with that? Very good question. So what we did last week was we were talking about, or the last couple of weeks, we've been talking about this big pennant that's on gold on the daily time frame and how it broke. So you can see here it closed high. First time it had done that, because this is just a wick, and then it continued on to a new high. So we're looking at, we were looking at buys at that point. Now, what we wanted to do is we also wanted to find a zone that made, I guess, a little bit more scalpy. So what we did was we had a look at the time frame. You can see here we've got series of kind of resistance around this $1,300 zone, comes down, and this is a very interesting candle. So right around that 100 moving average, we've got a bullish, does anyone know what that is? We did it a couple of weeks ago.
Well done, Rebecca, yes.
Yeah, Rebecca's right, yes. So this is a hammer. And it's a 4-hour hammer, and hammers signify bullish turnaround. So remember, the psychology behind a hammer is that the market has opened. During this 4 hours, it's been sold off, so gold was sold off, and then somewhere during that 4 hours, everyone's maybe taken profit, or the sellers have left, and buyers have come in and gained control and pushed it all the way back up. So it's kind of like that psychological shift. It could mean that usually it means it's hit an extreme level. And if it hits an extreme level and creates a bullish hammer, or some people are saying it's a pin, some people do call it a pin, but its real name's a hammer, then if you're buying off this and you've already got that overall, let's say, bullish signal, which is this pennant on the bigger time frames, then that's a great little buy zone. So I've just bought it here. Obviously, I just waited for that confirmation, and then I'm just selling some of it at this high point here. So we've got some at around that 1290 area, so those previous peaks. So that's a little bit conservative take. And then I've also got a big longer term take profit which is based on the pennant. So with pennants, what we can do is we can draw the move into the pennant. I'll just quickly pull that out, and then you can take the distance of that move and then basically say that's how long it should go for. Now, that's a massive take profit. A lot of people are going to be like, that's crazy. You know, how can you call that? If you go look at the US dollar yen, you'll see a big pennant on that. And have a look at a US dollar yen weekly. I'm sure people will be able to find it, and you'll see it did go the distance.
Nothing is impossible.
Nothing's impossible. If you like, this is the amazing thing about technicals. You can see it months out if you know how to read it. And sometimes you can get some really big moves, and they can be the game changers for you.
Definitely. Now, we've got a question from Ben asking about that hammer that we were talking about, and is it more significant than other candles?
4 hour.
Let's have a look. We've got the 4 hour.
4 hour. Yeah, I'm not sure. Yeah.
4 hour. And yes, you are right in that it is a more significant hammer. Do you know why, Ben? Do you know why it's a more significant hammer actually? Yes, very good. Yes, that's right. It's a hammer that's actually gone underneath the 100 moving average and pulled back nearly above it. It did by the time it closed. It actually did close above the 100 moving average. Does that add extra weight to the candle pattern? Absolutely, it does. Because what we're doing is we're getting double confirmation. Not only are we getting price action in the candle telling us that we've had a big rejection there, but we're also getting a significant moving average holding its support. Okay, so it's finding support at the moving average. It failed to break that level, and it's reacted quite strongly, quite aggressively actually. So for anybody who does trade hammers, if you do see it reacting with a solid moving average like the 100 is in that manner, it definitely gives you more weight to say that you definitely add an extra percentage or two of value to that trade. I certainly do anyway.
Yeah, you should always have a score list whenever looking at trades. So some things people don't have is like a tick box. If you have a tick box, and it'll actually stop you from taking bad trades. So I'm sure we've all taken bad trades, but if you have a tick box in front of you and you have to, when you were, let's say, sane and making a lot of sense in terms of your trades, if you had a methodical method to get into the trades, if that doesn't make sense or it's not meeting those criteria that you set before, then you probably shouldn't be in it. Now, just going back to the daily, or weekly, I wanted to just say the reason why I've got this take profit here sitting at around, let's just quickly get the price for you, around that 1380 zone, is that's kind of the average of the previous peak. So this whole pennant is signaling 1450, which is that high over here. I want to go more conservative than that, so I'll put the smaller trade on for a take profit of 1380-ish. So you can see here, 1378. And I'll put the bigger trade on for a take profit of 1293. So that's the more conservative kind of take profit. The reason I do this is purely so that you can have trades in for longer period of time. If you have trades in for longer period of time, you can eventually get comfortable with that kind of method. You put a small contract on it, you put part of your risk on it, and it's amazing how all of those can add up, and you can take some seriously large wins when you analyze the bigger time frames. So I encourage, consider trading smaller contracts maybe on the bigger time frames and start long holding positions and see what happens, because it's amazing what it can do to your trades.
It's the best way to get your confidence up, to see a couple of big trades.
Taking 10,000 pips?
Absolutely. If you take 10,000 pips...
Wait, 1,000 pips, sorry. 10,000 pips would be a lot. Yeah. But, taking 1,000 pip wins and stuff like that, it's, I remember my first one, it's a good feeling.
It is, absolutely. And it does really give you a lot of confidence in that the price, will and can get to the levels that the technicals indicate it will. So taking good profits along the way is great, but watching a trade completely fulfill its potential will really do a lot for your confidence, and it'll give you a lot more, confidence in the future to actually let them play out, which is the most important thing.
I'm just going to do it. I'm going to bring back the US dollar yen pennant. So here you can see the pennant, very clear break. And I always talk about it because it's a really good example.
Thomas can't help himself. He loves this trade.
I do love this trade. But you can see that this is the expectation. So that's the pole area. It breaks, it goes high, it never comes back down. And you can see it almost 100% to the dot. That's exactly where the market went. And for people like me who take about 80% of it, I would have been taking profit around here. So you can see a lot of people did that as well.
And for the haters out there who are saying that gold is not going to reach that point, if you actually overlay this pennant with what gold is actually doing right now, it's almost identical. If you cut out what's happening here on this pennant and coming back, it's the exact same place that gold is at the moment.
Very similar. But you had to be super patient with this trade, because it sat there, and this is a weekly chart, remember. It sat there and went down, did nothing for 34 weeks. So for a lot of people, that's going to be too long. But interesting. You have a small trade on there. You just leave it. You don't feel stress about it, and it's amazing. You can take quite a lot of money. You put $50 on it, and then all of a sudden come back in a couple of years, and that $50 is almost $1,000.
So you're saying, Thomas, that we have to wait 34 weeks for the gold trade to play out?
No, you can always take the distance. So generally what I like to do is you take the distance of the pole, 36 weeks in this case, and then I times it by 1.5-ish, and if you times 36, I'd be around here. So at about 50 weeks, I think if you did the numbers, 50-ish, that's where I would be out. And you can see it hit almost all of it by that time.
Yeah. And for those of you out there who are thinking we're absolutely crazy, We are looking at a weekly chart. So these projections that we're talking about, when we're looking at a weekly and monthly charts, everything is very, very long term. Trends can change over a matter of years, not weeks and days. So everything is all very relative to the chart that you're looking at.
It's very much so. So at the moment, we're at a critical point for the US dollar yen. You can see here we've got this resistance, support, now support again. It's amazing. It almost just tapped it absolutely perfectly, and now it's going long. So this could be a definitive moment for the US dollar yen. Will it go bullish again and move all the way back up, or will it just struggle around here for a while? And this all comes down to the Reserve Bank chairmans. So it's really important that if you want to trade the yen, be very much on their outlook for Kuroda and making sure you are there, or at least have a fair understanding of what Kuroda said or is saying and when he's saying it. So always have a little bit of a look at an economic calendar and just check those bits of news out, because they do make a big difference, even to technical traders.
Definitely.
All right. Well, I think that really ends this week. We've got our gold trade on. We'll check that out next week. We've got a couple of others that we're looking at, so we'll place them during the week if they do hit. One thing I did want to say was the Euro US dollar. We do have an interesting signal on this one. We've got a weekly candle that it's actually a shooting star that's closed, confirmed. I'd like to see a bearish candle this week on this one, but you can see resistance, 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 and it's never broken above this point. So it did wick it once, but it never broke and closed on the weekly. So at least from a technical standpoint, this is a decent sell. I mean, you could be looking at a sell here with a stop above the shooting star. It's not the best because you haven't got confirmation after that shooting star yet, but interesting one.
Yeah, definitely. Sally's asking, would we short the euro from here? Sally, I would like to see personally a new low. I think if we get this low closing below the last candle here, I would start to say that this is probably looking like a potential decent move short. But I would like to see a little bit more confirmation because there is a little bit going on at the moment. So
it's also the fourth or fifth time it's come to this point, and at some point, if it's going to go long, it is going to break. So even though it's showing us this signal, we want to see further confirmation. So we've got our resistance, we've got our shooting star. Let's wait for a confirmed new close low and then potentially get in.
Excellent.
All right. Well, that's great, guys. Thank you very much. Really appreciate everyone's questions. And as always, I think we need to get a little bit more on this. If people could start sending us more of their trades, I'd love to do a segment at the end of each week and talk about their trades and specifically what they're doing right, what they're doing wrong, and getting that analyzed. So thank you again.
Thanks, guys. Thank you very much for joining us, and we look forward to seeing you all again next week.
All right, guys. See you next week. Bye.